Imagine you build a literal money printing machine, right?
Okay, I'm with you.
You turn it on, you prove to the entire world that it works perfectly, and then Wall Street ruthlessly punishes you for buying the metal required to build the machine.
Yeah, the cost of doing business.
Exactly. That is exactly the situation playing out across the financial landscape right now.
It's wild. We are seeing just a profound contradiction in how capital is being allocated.
Welcome to the deep dive. I'm really excited to get into this one with you today.
Same here.
Because today is Tuesday, August 4th, 2026, and the market is, on its face, entirely paradoxical right now.
It really is. I mean, the daytime trading session gave us historic, record-smashing highs across the board, just massive.
But then the bell rings.
Right. The moment the closing bell rang, some of the most innovative companies on the planet were aggressively sent to the penalty box in after-hours trading.
And that's our mission for you today on this deep dive.
I'm
We have
pumped
this
up.
stack of end-of-day market data and these after-hours earnings reports.
The major indices are throwing an absolute party.
They are. But the companies actually building the futuristic infrastructure of tomorrow, they're getting handed a massive bill.
So we really need to figure out what happens when the companies building tomorrow hand Wall Street the bill today.
Exactly. So let's jump right into the numbers from the regular trading session.
Because they paint a picture of a market that has just completely shaken off its recent anxiety.
Yeah, that summer reset we experienced back in July, it seems to be officially in the rearview mirror.
It really does. The broader macroeconomic picture is showing remarkable resilience. I mean, Wall Street didn't just walk back into the market this week. They sprinted.
They sprinted hard.
Yeah.
Let's look at the S&P 500. It closed at 7,736.52.
Which is a 1.8% jump.
Right. But the detail that really stands out to me here, this is the 25th record close of 2026.
And we're barely into August.
Exactly. To put that in perspective for you, hitting 25 record closes in just over 7 months. That means the market is finding new all-time highs every week and a half on average.
It's a staggering pace. And the momentum was it was everywhere today.
The Dow Jones Industrial Average hit 54,085.8.
A 1.7% jump right there.
And its second consecutive record close. Plus, the Nasdaq surged 2.6% to 26,584.9.
Even the Russell 2000, which tracks the smaller companies, that jumped a very solid 1.8%.
It's a clean sweep across the board.
It really is.
So my question for you, what was the mechanism here? Like, what made the market wake up on a random Tuesday in August and decide to buy literally everything in sight?
Well, the primary catalyst wasn't an earnings beat or some major tech breakthrough during the day. It was actually a geopolitical relief valve.
Okay, geopolitical.
Yeah, analysts are calling it the Bessent bounce.
Named after Treasury Secretary Scott Bessent.
Right. He made some highly anticipated comments signaling a potential deal with Iran that would reopen the Strait of Hormuz.
Okay, I think we really need to unpack the mechanics of that for a second.
Sure.
Because for anyone listening who, doesn't track global maritime shipping routes for a living, why does one specific waterway in the Middle East have the power to move the Nasdaq 2.6% in a single day?
It's a great question. So the Strait of Hormuz is essentially the jugular vein of the global energy market.
The jugular, wow.
It is. A massive percentage of the world's oil passes through that narrow choke point. So when there is military tension or, a threat of closure there, global oil prices spike immediately.
Just purely on the fear of a supply shortage.
Exactly. And expensive oil acts like a massive hidden tax on the entire global economy.
Because petroleum is baked into the cost of literally everything.
Everything.
It's not just the gas in your car. It's the cost of fueling the huge cargo ships bringing electronics across the Pacific.
The diesel for the delivery trucks.
Right. The cost of manufacturing plastics for medical devices. Like when oil goes up, the cost to make and move everything goes up.
Which means profit margins shrink across every single sector.
So companies are forced to raise prices.
Exactly, which keeps inflation high. And when inflation stays hot, the Federal Reserve is forced to keep interest rates high.
Making borrowing money super expensive for businesses trying to grow.
It is a massive domino effect. But, and here's the key, Secretary Bessent's comments signaled a de-escalation of that exact threat.
Okay, so the fear evaporated.
Right. And the immediate mechanical result of that news was Brent crude oil dropping 3%. It actually fell back below $80 a barrel.
So the logic flow for Wall Street is lower oil prices mean lower shipping and manufacturing costs,
Yes.
which cools down inflation fears, which lowers bond yields, giving stocks the ultimate green light to just run.
That's the playbook, yeah.
But I want to push back on that logic a bit,
Okay, let's hear it.
because it seems a little short-sighted to me. Like, is this a structural, fundamental victory for the economy, or just a temporary sigh of relief?
That's the million-dollar question.
To me, it feels like, okay, imagine you're driving down a really stressful, dangerous stretch of highway in a massive rainstorm.
Oh, I hate that.
Right. You're gripping the wheel, your jaw is totally clenched, you're exhausted. Then the rain clears up just a tiny bit.
You can finally see the road.
Yes. You unclench your jaw, you drop your shoulders, you breathe. But you haven't actually reached your destination yet, and your car still has the exact same amount of gas.
But the immediate heart-pounding panic is gone.
Exactly.
Well, to use your highway analogy, institutional investors are acting like day traders right now, not city planners.
Oh, I like that. Day traders, not city planners.
They aren't looking at the destination 5 years down the road. They're looking at the condition of the pavement today. The structural realities of the global economy haven't transformed overnight. But the risk premium, that extra anxiety tax investors were pricing into stocks just in case a war broke out, that evaporated.
So they realized the absolute worst-case scenario wasn't happening this week, so they just smashed the buy button.
And they hit it hard.
They really did. But here's where the data gets super fascinating. When you look under the hood of this Tuesday rally, Wall Street was rewarding very specific, tangible results across sectors that seemingly have nothing in common.
Total opposites, really.
Let's look at the day's two biggest superstars. On the tech side, we have Palantir, ticker symbol PLTR.
Oh, wow. Yeah.
This stock went up 29.5% in a single day.
Just a phenomenal upward move.
Insane.
The driving force there was their CEO, Alex Karp, reporting a 93% revenue growth. He actually described the quarter as otherworldly.
Which, by the way, is a wild adjective for an earnings call.
It really is.
Usually CEOs lean on very safe, sanitized words, like synergistic or robust.
Very corporate speak.
Exactly. When a CEO drops otherworldly on a call with institutional analysts, the spreadsheets must look absolutely staggering.
They have to.
But a 93% revenue growth for a company that is already massive, that defies the law of large numbers.
It does.
Usually, only tiny early-stage startups can double their revenue in a year.
But that is the key differentiator here. Palantir is proving that their artificial intelligence software has crossed a massive threshold.
It's not just a toy anymore.
No, it's no longer just a pilot program or a beta test or some shiny R&D project. Corporate clients and government agencies are paying massive premiums for operational AI right now.
They are monetizing the software at an unprecedented scale.
Exactly.
Okay, so you have this futuristic, invisible AI software absolutely crushing it.
Right.
Now, let's look at the other side of the spectrum. The industrial titan that also had a historic day today, Caterpillar.
Ticker CAT.
Yes, CAT, the people who make literal steel bulldozers, excavators, and mining trucks.
Very different from AI software.
Completely different. But they jumped 5.7% at the close and were up a full 10% intraday.
Massive move for an industrial.
And they crossed the $20 billion mark in quarterly sales for the very first time in their entire history.
20 billion. In a quarter.
So you have digital ethereal algorithms on one hand and massive diesel-guzzling yellow machines on the other. What actually ties these two completely different businesses together?
It's simple, really. They are both providing immediate proof of monetization.
Immediate proof.
Yes. Wall Street is currently obsessed with companies that are generating hard cash today.
Right now.
Exactly. Whether you're selling cutting-edge data analytics or thousands of pounds of industrial steel, investors are ruthlessly favoring companies that aren't just selling a 10-year vision.
They want to see the cash hitting the balance sheet this quarter.
Caterpillar's selling $20 billion worth of heavy machinery tells us that physical global construction and infrastructure projects are actively happening.
So Wall Street is saying, show me the money right now, not in 2030.
Wall Street is sending a very clear message. We will reward you handsomely, but only if you can prove your business model is a cash-generating reality today.
Which brings us to the after-hours trading session.
This is where things get weird.
And this is the central paradox we promised you at the top of the show. Because if the market loves growth and the market loves revenue beats, what happened after the closing bell makes absolutely zero sense.
It defies logic.
Let's talk about SpaceX.
This was a highly anticipated data drop. SpaceX, ticker SPCX, reporting its first ever quarterly earnings as a publicly traded company.
And by all traditional metrics, they completely knocked it out of the park.
They really did.
They beat Wall Street's revenue expectations by a mile. They brought in $7.8 billion versus the expected $6.81 billion.
That is nearly a billion-dollar beat.
Right. So if we apply the logic we just established with Palantir and Caterpillar, where massive revenue beats equal massive stock surges, SpaceX shares should be in orbit right now.
The expectation certainly would be a massive rally.
But the stock actually fell 5 to 8% in after-hours trading.
Unbelievable.
And it wasn't just SpaceX catching this bizarre headwind. Look at Advanced Micro Devices, AMD.
They are at the very heart of the AI hardware boom.
Exactly. They reported record revenue of $11.4 billion.
A 50% jump year over year.
50%. And they also beat earnings per share estimates, bringing in $1.66 per share versus the expected $1.62.
Which is a solid beat.
And just to be clear for you listening, when we say they beat expectations by 4 cents a share, that might sound trivial to an everyday listener. Like, why does Wall Street care about 4 pennies?
Well, because when you multiply those 4 pennies across the billions of outstanding shares a company like AMD has, you're talking about hundreds of millions of dollars in unexpected net income.
It scales up incredibly fast.
It does. An EPS beat proves that the company isn't just bringing in more money, but that their profit margins are incredibly efficient.
Right. They're keeping more of the money they actually make.
Exactly.
So they have record revenue, they have highly efficient profit margins, and on top of that, their guidance for the third quarter topped expectations.
Everything you want to see.
They did every single thing a public company is supposed to do, yet their shares also slipped 7 to 8% after hours.
Yep.
How do you beat expectations across the board and immediately get punished by investors?
We have to look at the expense column. This is what we call the Capex Conundrum.
Capex, capital expenditures.
Right. Capex is the money a company spends to buy, maintain, or improve its physical fixed assets.
So we're talking about land, buildings,
Cooling systems, specialized equipment, servers.
and in SpaceX's case, literal rockets.
Literal rockets.
Yet the incredibly expensive cost of building the future.
And that cost is accelerating at a rate that is terrifying institutional investors.
Terrifying them.
SpaceX saw its capital expenditures double in a single quarter. They spent $15.83 billion to fund the expansion of their Starlink satellite network and their internal AI infrastructure.
Almost $16 billion in 3 months.
And meanwhile, AMD saw its data center capex completely triple.
Triple.
What we witnessed in the after-hours market was severe sticker shock. Investors looked at the massive revenue, cheered for about 5 seconds, and then looked at the astronomical bill for the AI and space race and just gasped.
I have to challenge this Wall Street mindset, though,
Go for it?
because it seems entirely flawed to me. Isn't this exactly what these companies have to do to survive?
I mean, yes.
If you're SpaceX, your entire mission is to build a massive global satellite internet network and eventually, establish a presence on Mars.
That takes money.
And if you're AMD, you are in a literal knife fight with NVIDIA to build the physical chips that will power the next century of computing.
Absolutely.
You don't have a choice. You have to spend the money.
The companies absolutely have to spend it to secure their market share for the next decade. And here's the friction: Wall Street operates on a strict 90-day cycle.
Quarter to quarter.
Exactly. It's a fundamental conflict of time horizons. The founders and the engineers are looking at a 10-year roadmap, while the institutional investors are panicking about the profit margins for the upcoming quarter.
Right. So when a company triples its spending on data centers, investors immediately worry that the cash pile is shrinking today.
They want the cash today, not the infrastructure tomorrow.
To put this in perspective, it's like Wall Street is punishing a construction company for the cost of pouring the concrete for a massive new toll road.
Oh, that's a perfect way to look at it.
Right. They are completely ignoring the fact that once the road is built, the company will collect every single toll for the next 50 years.
Yes, concrete is incredibly expensive.
But if you don't pour the concrete today, you don't collect the toll revenue tomorrow.
And this highlights a crucial division in the market right now. We can actually call it the Great AI Divide.
The Great AI Divide.
Yeah, if we compare the daytime surge of Palantir with the after-hours drop of AMD, the mechanics of this divide become incredibly clear.
So are we looking at a timeline and scale issue?
Yeah.
Palantir is selling software that already exists today, while AMD is buying the raw materials to build things for tomorrow.
That is the core of it, and it really comes down to how different technologies scale.
Okay, tell me more about that.
Well, Palantir is a software company. Think of software as digital blueprints. Once Palantir's engineers build the core AI platform, replicating it and selling it to a new corporate client costs almost nothing.
You essentially just hit copy-paste.
Exactly. Software scales beautifully because the margins are incredibly high, and they don't require massive new physical overhead every single time they sign a contract.
Right, they aren't out there buying copper wire and silicon to build a new factory just because they sign a new hospital network as a client.
Exactly. But AMD and SpaceX represent the hardware layer, and hardware is stubbornly trapped in the physical world.
You cannot copy-paste a microchip factory.
Or a rocket.
Right.
To grow, you need more fabrication plants, more raw materials, massive amounts of electricity, industrial cooling systems, and thousands of acres of real estate.
They are building the physical skyscrapers of the new economy.
And you have to buy the steel and pour the concrete every single time. Wall Street is currently rewarding the digital blueprints because they are cheap to distribute, while aggressively punishing the hardware companies for the immense cost of building the physical skyscrapers.
Wow, that distinction really frames the anxiety perfectly. Palantir is selling the digital blueprint, and Wall Street loves it. AMD and SpaceX are pouring the concrete, and Wall Street is groaning about the bill.
Groaning loudly.
And to be fair, a $15.83 billion capex bill for SpaceX in a single quarter, that is a staggering number for the market to digest, even with a billion-dollar revenue beat.
It is. It forces investors to ask how long these companies can sustain that level of spending before it starts eroding their fundamental valuation.
So Wall Street is sweating over billions spent on server farms and rocket ships. But what about the actual everyday economy?
Yeah, the Main Street economy.
Are everyday consumers feeling this Besant bounce? Or is this structural health just a Wall Street illusion? Let's transition away from the tech anxiety for a minute and look at a few final indicators from the broader market, starting with the American consumer.
This is where the data gets very encouraging, actually.
Let's look at McDonald's, ticker MCD.
Okay.
They rose 1.7% today. And the mechanism here is fascinating. They beat their spring profit expectations.
Which is a huge signal.
Right, because there has been so much widespread fear about inflation completely crushing the middle-class consumer. When lower and middle-income households feel the pinch of inflation, fast food is often one of the first discretionary expenses they cut.
They eat at home instead.
Exactly. But McDonald's beating profit expectations tells us that the consumer is still resilient. People are absorbing the higher prices, and they're still buying burgers.
It shows that consumer spending hasn't cratered the way some of the more bearish analysts predicted last month.
Definitely not. And then you look at the financial sector. Prudential Financial, ticker PRU. They almost doubled their net income year over year.
Oh.
They reported $2.80 per share, up from $1.48 in the same period last year. That is a massive jump in profitability for a legacy life insurance and financial institution.
A strong financial sector is really the bedrock of a healthy market. If companies like Prudential are doubling their net income, it means capital's flowing, investments are yielding returns, and the credit markets are stable.
And just to add one more data point to show the breadth of this rally, Lucid Group, ticker LCID, the luxury electric vehicle maker.
Oh, yeah. How do they do?
They tipped up 4.3% in late trading after their quarterly update. So from fast food burgers to legacy life insurance to luxury electric cars, the underlying economy looks structurally sound.
This broad participation across sectors gives us some vital context. Scott Rubner, a prominent analyst over at Citadel Securities, put out a note today calling for happy days ahead for the market.
I always appreciate an analyst who cuts through the jargon with a phrase like happy days. What's driving his optimism?
His core argument relies on two major shifts. First, he notes that intense retail leverage is finally normalizing. And second, the hyper-concentration we saw earlier in the year is breaking up.
Hold on. I want to clarify those terms for you listening because they are crucial to understanding market health.
Sure, let's break it down.
When Rubner talks about retail leverage normalizing, Is he saying that everyday retail investors are finally backing off from aggressively borrowing money on margin to buy tech stocks?
Yes, exactly. And that reduces the systemic risk of a sudden crash.
Because if the market dips,
Right. When too many everyday investors are borrowing money to trade, a small dip in the market can trigger a wave of forced selling known as margin calls. By that leverage normalizing, the foundation of the market becomes much less fragile.
makes total sense. And the hyperconcentration he mentions that refers to the fact that for the first half of the year, all the market's gains were driven by just a handful of massive tech companies, the Magnificent Seven.
Yes, while the other 493 companies in the S&P 500 did basically nothing.
That top-heavy concentration is incredibly dangerous, right?
Very. If one of those 7 tech stocks faltered, it could drag the whole index down. But the fact that capital is now flowing broadly into industrials like Caterpillar, financials like Prudential, and consumer staples like McDonald's, it shows that the rally is broadening out.
The market is no longer a precarious house of cards balanced on 3 AI stocks.
The foundation is widening, which makes the whole structure safer.
If capital is finally flowing back to everyday companies like McDonald's and Caterpillar, while simultaneously penalizing the massive infrastructure spending of tech giants, it leaves a lingering question for the future of innovation.
It really does.
And I want to leave you with a final thought experiment to ponder as we wrap up this deep dive.
Let's hear it.
If Wall Street is actively punishing undisputed titans, like SpaceX and AMD companies that have beaten earnings, generated record revenues, and hold massive cash reserves simply because they have the audacity to spend billions pouring the concrete for tomorrow's technology.
Yeah.
How can any smaller startup possibly compete?
That is the scary part. If the public markets refuse to tolerate the capital expenditure required to build next-generation hardware, even from proven profitable winners, the barrier to entry for newcomers becomes completely insurmountable.
Are we accidentally, through the relentless pressure of 90-day earning cycles, incentivizing a future where only a tiny monopoly of ultra-rich megacorporations can afford to build tomorrow's technology?
It's a real risk.
If Wall Street hates the cost of the concrete, only the companies that already own the world will be able to build the new roads.
Yeah, that's heavy.
Something to keep in mind the next time you see an innovative company punished for investing in its own future.
Thank you so much for joining us on this deep dive. We love unpacking this data with you, finding the actual signals in the noise, and figuring out what it all means for tomorrow. We'll be right back here with you next time to do it all again. Until then, keep questioning the numbers.